Hey guys, thanks for joining us today. We've got Ed from the OIC with us. I'm going to go ahead and let him start.
Great, thanks Maria, and welcome everybody. It's always a pleasure to speak to the BlackBox group, one of my favorite routine sessions that we do. Today will be about long volatility strategies. Here is our OIC risk disclaimer and about us. Our website is optionseducation.org. That's where you'll find the written education that we have along with our podcasts, videos, and archived webinars. We also do a Wide World of Options monthly podcast with guest speakers, and that's something that I host on a monthly basis. Industry professionals come on to talk about options, and then we have some other fun segments. We do a new show every single month, and we put those on the website as well, so check those out. And you'll hear me mention this at the end, but also here at the beginning, the Investor Services Desk is a team of professionals that the OCC provides to the public who will answer your options questions. So you can email them options@theocc.com about anything we talk about today, any of the concepts, or anything else options related. That team will answer to the best of their ability within one business day. And here's the outline for today. Long volatility strategies, of course, is going to be fairly heavy with the Greeks, so there will be plenty of material on that. For those of you joining us on a routine basis, some of it will look familiar to presentation from a few months ago on the Greeks, but as we say very frequently at OIC, repetition is a good thing, so we will be a bit heavy in the beginning on Greeks, specifically with Vega and Theta, and then we'll get into the strategies: long straddle, long straddle, long straddle, long strangle, and compare those two to each other, look at the risk reward profile, and offer some insight on strike and expiration selection. First of all, from an overview, from a very general high level perspective, what is volatility? It certainly has nothing to do with the starting point or the ending point of stock movements, but rather the fluctuation in between. More highly volatile stocks show variance or deviation from their starting and ending points than low volatility stocks. We're not going to get too heavy into the math today and talk too much about the percentages and the calculations within volatility themselves, but you do need to understand that the fluctuation or movement of prices is what volatility represents. And the various types of volatility, which we're just about to get into in just a minute here, can be calculated and looked at different time intervals or different lengths of time. Whether you're looking backwards or forwards, it is up to the investor to decide what length of time they're going to use, and that length of time is likely going to be decided depending on your time frame or your outlook, short term, medium term, or long term. What do you want to use to analyze what the stock has done or what it might do in the future? And of course, volatility does not imply a direction. There is not a bias. The type of thing you might see or hear from economists or market analysts who implement a upward bias in the overall market. Volatility does not do such a thing. The number that it represents is simply fluctuation of stock prices either up or down, and it assumes an equal likelihood that the stock will move in either direction. So it's a percentage that indicates how far up or down with equal likelihood in each direction the stock might move. We want to first start with historical volatility. You can think of this as observed volatility, which is what the stock has done in the past. These are known numbers that you can gather. There's data available where you can retrieve this kind of information and quantify it. This is what historical volatility is. It doesn't predict the future. It looks backward in time. So there are some limitations here as an investor, whether you're looking at stocks or options. What's important to you is where the stock is headed in the future. That's what you really want to know. Where it's been in the past certainly has value, and you can use that as a baseline to try and determine where you think the stock might be moving or what range it might be moving into in the future. And again, here with historical volatility, you can choose for yourself what time frame you're going to select. A 10-day historic volatility number will look at the past 10 days. You can go out much further and look out 90 days or 120 days and get a much wider, longer term look at what the stock price movements have been. You could decide on one or the other based on what you're trying to accomplish with your trade and your style and the time frame with which you expect to hold a particular trade, whether you're going to look at the shorter term or longer term. Right in between those two, roughly, is about 30 days. I think that would be considered the most popular level, 30-day historic volatility. We have those numbers on our website, and that's a bit of a sweet spot between short-term and medium-term outlook. And again, 30-day volatility would look at the past 30 days of stock price movements and indicate what that volatility level has been, and then would update every single day with each new trading day. One new piece of information is added and one is subtracted, and you can continually look at the historic volatility levels and track where they're at versus where they have been. And that's really the idea, is to start tracking current levels versus where they have been. Ultimately, what we want to come to a consensus on or an opinion on is what's going to happen. That helps us make a trading decision, and what the future holds is what's known as implied volatility. This is specific to options prices. Implied volatility only exists in the options space, and it is the volatility assumption that is being used to derive a particular options price. You can calculate this backwards if you know all of the relevant inputs that everybody else knows: the strike price, the stock price, the days to expiration, interest rates. If you also know the option price, you can reverse calculate and get what the implied volatility level that is being used to price that option. You can determine this via a pricing model. I don't want to get too deep into pricing models, but one way to look at this, and it may help you understand it a little bit better or maybe remember it more easily, option pricing models, from a very hand-wavy analysis or interpretation, they interpret the potential future values of an option based on various levels of stock price, certain potential stock prices up and certain potential stock prices down, and what would the option be worth at all of those different levels. Of course, some of those levels will be out of the money options and it'll be worth nothing, and others will be in the money worth various amounts. When you average all those numbers and take the present value, you can then calculate or derive a price, and that's, in a very rough general sense, what pricing models are doing when they look out into the future at future levels of the stock. If you increase the volatility level that you're using to do that, then you're increasing or fanning out the range of stock prices that could be achieved over that time period. And if you do that, then the in the money strikes all of a sudden become a little more in the money, and there's a few more possibilities there. So you have more values that you are assuming the stock could reach. More values averaged out are going to yield more, a higher option value theoretically. So that's one way to think about it. This is, of course, using the binomial option pricing model, looking out into the future. As a higher volatility level is used, a wider range of potential stock prices is used as future values, and that increases the potential value for the option. So that is what implied volatility is, and it's considered the great unknown. Nobody knows what implied volatility levels are going to be like today or tomorrow or next week. The market is constantly trying to figure that out. If I think back to 20 years ago, when I was on the options trading floors in Chicago and New York, this is what we were doing every day with the group that I was trading with. It was a group of about 8 of us that were trading mostly index options, but also some equity traders there as well. We were looking at implied volatility levels all day and trying to line them up, trying to line up our volatility levels with what we were seeing in the market. Now, each strike price has its own volatility level attached to it. And if you were to plot that with strike prices on the x-axis and volatility levels on the y-axis, generally speaking, the lowest strike prices have the highest implied volatility levels. And that's because those cheap out-of-the-money puts rarely get sold to open. On the flip side, they are frequently bid up to protect portfolios against big market moves lower. So if there's bids that kind of stick for those lower priced options, and it's fairly rare to see sell to open trades for cheap puts, then naturally those implied volatility levels have to be very high. Now, as you move higher in strike price, the implied volatility level comes somewhat down until you reach just above the at-the-money strike, where it'll bottom out, and then you have another slight uptick, where again, the same type of phenomenon on the call side, not nearly as drastic as the puts, but same type of idea, where those very cheap calls all of a sudden aren't going to be sold too often because the risk reward just isn't there. So volatility picks up as you get to those further out of the money call strikes. And if you visualized how that works and connect all of the dots, that's what volatility skew is, and that's what volatility smile is. Now, when I was on the trading floor, we considered the out of the money puts to be the put wing, like a bird wing. We called it the put wing, and the out of the money call strikes were considered the call wing. And when we communicated with each other across headsets, across different pits, even on different exchange floors, we had to be very specific. If we thought implied vol was low at a certain level, we couldn't just say stock XYZ, April expiration, volatility is low. That wasn't enough information. We needed to know where it was low. Is it at the money? Is it the call wing? Is it the put wing? And maybe even more specific, are we talking 50 delta puts or 35 delta puts? Where are we at? And then we could adjust that volatility skew appropriately by very fine-tuning, by fine-tuning what that skew looked like, literally clicking and dragging that volatility skew and then reestablishing new theoretical values. So it's very important to understand what implied volatility levels are, that they're different across strike prices, and that they're changing throughout the day. What we want to do as we're putting the pieces of information together and coming to a determination on a trade, specifically to options, is start to compare things to each other. And that's what comparing implied to historical might be about, or we'll get to in a second, comparing implied to itself. The future implied vol levels, or the future potential movements of the stock price, can be very different from what you've observed in the past. And that can be a bit challenging to evaluate. You can't be quite certain whether or not there is a new norm in a particular stock if what you're seeing is implied vol levels that are high or low for a particularly good reason. You do have to do some vetting on that. And this gives me a chance to speak briefly about a trading portfolio that I had worked on with a small hedge fund back in the early 2000s. We traded volatility levels all day, every day as one of our 2 or 3 investment strategies. And this is what we were doing. We were looking at implied volatility levels, and if they appeared to be high, we had to discuss that and try to figure out if there was a good reason why they were high or low, and do the best vetting process that we could. After having completed that, we could then determine if it was worth taking a trade. And certainly with trading volatility levels, as we'll see later on, Straddles was the trade to make, either buying or selling Straddles as a direct play and a clean play on pure volatility movements. So with implied compared to historical, it's very common to think or to expect that implied is going to revert back to the stock's long-term historical average, but it doesn't have to be that way. I've spoken to many investors who state that as a fact, that volatility is mean reverting. And it's tough to argue with that, but as an educator, I think it's important to at least stipulate that implied vol levels certainly don't have to be mean reverting, or volatility in general does not have to be mean reverting. There could be changes for a good reason, and that could lead to a new norm. We just talked about looking at implied versus historical, but when I gave that description of what my firm was doing when they were trading volatility levels, they really were trading implied vol levels against themselves. And that's what I would call historic implied, not comparing the implied vol levels with the historic levels, but looking at today's I-vol levels and comparing them with past I-vol levels. That is more of an apples to apples analysis. And when you do that, you may have a little bit more clear insight into what implied levels have done in the past and whether or not they are generally higher than historic vol levels. They might be, and they may continue to be that way. So comparing implied vol levels to themselves is what you generally see more frequently from the professional trading world. It's rather difficult for the individual investor to do this type of analysis. I think it's incredibly valuable to understand how it works and to be familiar with it, but it is rather data intensive. On our team, we had several financial engineers who were taking data from the exchanges and then manipulating it and then helping us analyze what those numbers looked like. And then a small team of us who were the actual traders did the vetting and the trade execution and the position management. So it was rather complex to do that type of analysis. I wouldn't expect too many individuals to be in a position to do so, but it certainly gives good context to understand what that means and what it's all about. Another side to this, and to clarify, implied volatility by itself is not a Greek, and that's what we want to get into here. The Greeks and their effect on option prices. Implied volatility is related to the Greek, which is known as Vega. Vega is defined as how much will an option price move with a 1% change in implied volatility. And if that's what you're looking at here, which we are today, the expectation that implied vol levels are going to move, we might want to know what effect is that going to have on option prices or the specific position that we have on. It should come as no surprise that as implied vol levels go up, all option prices go up. Back to that earlier explanation of the pricing models and the potential future stock values. If we increase the range of those potential values, then the pricing models would naturally give you a higher expected theoretical value. And as implied volatility levels go down, you would expect both calls and put prices to go down. It's sometimes difficult to use Vega if you're trying to predict what might this strategy, what might this position be worth if implied volatility levels go from 25 to 30 or from 45 to 55. That might be what you're looking for, but it's difficult to exactly predict that using Vega because Greeks are dynamic and they're changing all the time. One thing you can do, I'll mention this a few times today, is use a calculator. The Options Industry Council website does have an options calculator where you can put in all of the relevant variables and calculate call prices and put prices. If you did know today's situation with respect to all the Greeks, and you wanted to predict in a week or in 10 days, if vol levels go from this level to that level, a particular level that you choose, what does that mean for my option prices? Simply decrease the days to expiration, move the stock wherever you think it might move, change the implied vol levels and recalculate. And that's one way to very loosely try and predict what the prices might be worth and what the effect of implied vol levels changing might have on your position. Let's look briefly at an example of what can happen. Stock XYZ is trading at 50 and we have call options that are going for $3 each, couple months till expiration, and you have this stock moving back and forth, leveling off at 50. you look back at the stock or at the option price and it's moved up to 340. Now this is the effect of implied volatility levels moving and Vega, those two things working together. And you see here implied vol levels moving from 35 to 40% changed what the option value is worth, even though you have no change in the stock price. The most common circumstance to have a question come across my way with respect to these kind of changes is when there is a binary event of some kind and the market gets news and information that it was waiting for or expecting, and it usually happens the other way where the option price will decrease because of implied vol levels going down. And sometimes investors have picked the right direction, but you got to understand that there are forces working either with each other or against each other in the options space. Delta is one of them and Vega is another one of them. And if you are long Delta and the stock moves higher, that is working to your benefit. But if you are also long Vega and that's working against you, that may more than offset your delta gains. So it's a bit more complicated than just directional trading. Implied volatility levels do play a big role. It's worth mentioning at least once that none of this regarding implied vol levels and Vega, none of that matters when you look at expiration date P&L graphs. We get to the strategies, we'll do that. At expiration, there is no time value. Implied volatility levels don't matter, and your P&L graph is pretty cut and dry. But prior to then, you could have implied volatility levels moving in your favor and enhancing the position's P&L or working against you, and that could be at contrast or in conjunction with the effect of other Greeks, specifically delta. So it's very important to understand that. And I introduced Vega. Here it is, the expected change with a 1% move in implied volatility levels. You would usually expect that to be written in a decimal form. 8 cents per 1% change would be an example of that, and it represents cash. That's the actual amount of option value that you would expect to see change. Something that might not be intuitive is where is Vega the greatest and where is it the least? And with respect to strike and expiration, can everyone hear me okay?
I can. You cut out there for a minute.
Yeah, I got a little message here that says your audio was lost, and then boom, it came right back and said your audio's back. I don't know what that's about.
Alrighty.
Okay, let me just,
It's fine.
okay, good. I'll keep my eyes open for that going forward. So where was I? So Vega, where is it greatest and where is it least? Very important to know this, and it'll become crystal clear when we get to our example here in a couple slides. Vega is greatest at the money, and that might be common sense. As you go further out and out of the money, the changes in implied volatility levels don't matter as much. So Vega is greatest at the money, and it's also greatest long term. With more time to go till expiration, changes in implied volatility levels have a greater effect. Now I'll say one thing about expiration dates. Even though Vega is greater long term, when you have sharp movements in the stock or changes in implied volatility levels, you may see more sensitivity in the near term, meaning the long-term implied vol levels themselves may not change as dramatically as the near-term ones. So even though Vega is greater long-term, the net effect might somewhat cancel each other out because the movements in implied vol may be more extreme in the near term. But just again, from a conceptual perspective and educational perspective, Vega is greatest at your at the money strikes and for longer term options. And this will come to surface again when we go through the strategies. Theta is also very important because we're talking about options. So anytime you're buying or selling anything, theta matters. This is a simple graph of time decay as you get closer to expiration. Theta starts to increase, of decay increases. That's generally understood to be around that 40 days until expiration time frame. And as you get very close to expiration, that acceleration increases. And I want to emphasize that I do see a lot of presentations and educators out there who focus on that 40-day till expiration time frame as their sweet spot. There's certainly nothing wrong with that. But one idea that gets a little lost is that even though it starts to pick up at 40 days, it continues to accelerate. The rate of decay continues to accelerate all the way through expiration. The reason why 40 days is so widely used is because a lot of investors feel like that gives you a good mixture of the rate of decay along with the actual premium itself. When you are just minutes or days away from expiration, even though you have very fast time decay, you might not see that the premium amount is worth selling. And that's why there's sort of an analysis done on where's that sweet spot. Now, one other thing, think back to the skew outline that I gave earlier, where volatility levels are high with the lower and lowest strike prices. Theta, if you're looking at those values on your screen, which I'll show up on the next slide, Theta tends to be less reliable for cheap options, especially put options. In fact, for the very cheap put options, I would expect Theta to be completely inaccurate. And that's because with put options, as I said before, if they're worth a dime and they're supposed to decay from one day to the next, it's very likely that those bids stay there because money managers and banks and institutions are interested in downside protection and paying a little bit for it. On the flip side, very few are interested in selling those cheap options. So if time is passing and the price is not going anywhere, then not only is Theta wrong, but in order to justify that price tomorrow and the next day and the next day, implied volatility levels need to go up. And if you followed what I just said there, what it means is you would expect to see a steepening of the volatility curve as you approach expiration, simply because those cheap options hold their value. And as time disappears with less time till expiration and option prices not changing, the only thing that can result from that is implied levels going up. And I think that's important because you might notice that implied volatility levels are going up. It has nothing to do with an increase in demand. It's just simply the dynamic and the mathematics behind it. Less time, same price, has to equate to implied volatility levels going higher. And here's a look at Theta. Stock is at $50 a share. Looking at an at-the-money call and just seeing how that plays out from a year until expiration all the way down to a week till expiration. You can see that Theta gradually increases and that rate of decay gets faster as you're closer to expiration. And here again, I mentioned the OIC calculator earlier. If you want to investigate the effect of just time getting shorter and shorter, closer to expiration, a calculator is a great way to do that. Leave all of the other inputs the same, change the days till expiration, hit the recalculate button, and see what does that mean from one day to the next, and how accurate is the Theta that you're seeing on your screen. Our calculator also will show you those Greeks. So now we want to take this analysis. We have an opinion, and we know something about implied volatility, and we know something about Theta and time decay. And if we are of the opinion that we're going to see great movement in the stock price in the future as compared to what the market expects it to do. And I'll say that again, greater movement in the stock price in the future, not compared to previous stock price movements, but greater than what the market expects it to do. Because remember, options are priced based on that expectation. Then it leads us to the best strategies to use for that type of analysis that doesn't have a direction attached to it. And that's the long straddle and long strangle. Long straddle being buying a call and put at the same strike, usually at the money, and definitely with the same expiration date. Long strangle buying a call and a put, so just a cousin trade, very related to each other, but different strike prices and usually using out of the money options. The idea here is with any time you're buying options, you want movement in the stock price. The title of the presentation was Long Volatility Strategies. Well, anytime you're long options and net long options, you're going to have a long volatility strategy. These are the most direct and cleanest entries for that motivation. So these strategies are widely used for a particular event, an upcoming binary event of some kind that you think is going to move the stock price in one direction or the other. You're just not sure which one. When you're evaluating the price of these strategies, I'll just repeat, you are looking for a bigger move in the stock than the options market is predicting. So let's walk through P&L graphs and a fictitious situation with each, and then I can throw in some more details. Here we have Rosario, who's looking at the market and investigating a stock with a symbol JETX. And there's an upcoming announcement. If sales and revenue beat expectations, she's expecting the shares to take off, and if they're weak, she's expecting shares to decline sharply. With this forecast, the straddle or the strangle would fit. The next question is, does the price make sense? And is the price something that this investor feels like is worth trading? So here's the example of the straddle. Stock's at 87.5, and the straddle is defined as buying both the call and the put at that strike price. And in this case, we're going to pay $4. The maximum gain is unlimited because of the upside. There's no cap on how high the stock can go. As with anytime we're buying options, the most we can potentially lose is what we paid for it. In this case, that's $4. We shouldn't have to pony up any more money in our account than that. And we have break-even points on either side of that. Few things about strike and expiration here. For the straddle, it's assumed that the at-the-money strikes are going to be used. And there's a couple of reasons for that. I already outlined one of them. Vega is greatest at the money, and that is what we're trying to capture here. Remember, these are long volatility trades. We're expecting larger movements and increases in volatility. So we don't know where it's going, but we think volatility is going to jack in the future. So we buy at the money, which gives us the greatest Vega exposure. It also gives us that ability to go in either direction. If we chose to use an out of the money strike, then not only would our Vega exposure be less, we'd also gradually start to incur a higher cost, a higher net out of pocket cost, because we'll be paying intrinsic value on one side or the other. And we'll also have delta exposure. We'll have long or short deltas, which means we now have a market bias one way or the other, and that throws off what the analysis is. If you do have a market bias in one direction or the other, then you might look for a strategy to benefit from a movement in that particular direction. The long straddle is really neutral. So at the money is almost exclusively used because it has the greatest Vega exposure and gives you that either direction feature. Expiration date is rather simple. It's usually right after the binary event. There is some wiggle room for the investor to evaluate how much time they want after the event. It might just be a day or two, or you might want to give the stock some time to run after the announcement. We see that on a regular basis. After a binary event and a big announcement, a move occurs, and then that move may continue on for some time, days or weeks. So there is some flexibility on how the investor interprets where they want that expiration date to be. And one other thing I'll say, because I keep mentioning binary event, you could interpret, and I'm being kind of generous here and very loose with it, you could interpret a technical study as a binary event. For example, if you think the stock is just about to hit a very crucial key resistance level, and it's either going to fail miserably or it's going to break that resistance and take off to new highs, you could interpret that as an opportunity to trade the straddle at that price, right where that resistance level is. If the stock's bumping its head up at 90 and you think this is either going to get knocked down or take off from here, that could be looked at as an opportunity to play a straddle for a big move upcoming. The timing may be a bit difficult in those circumstances where you're using technical analysis, but you certainly could do it. So the P&L graph of the long straddle, here you go at the money, you have your strike price of 87.5, and that's the worst case situation. 87.5. Both options are worth nothing and we lose everything we put into it. In either direction, we start to gain. And of course, I have to say these expiration graphs are drawn with time value being at 0. They can only be drawn at expiration because we don't know what the values of these options would be prior to that. If it's a long vol trade and we want to see movement after an event and we're anticipating getting out of the trade prior to expiration, then you take this P&L graph and you understand it, but you expect to position to manage the position before that. If we do hold this through expiration, like many option strategies, you may manage it differently depending on what side of the at the money strike we're on. If the stock is lower and you want to continue this trade, you may be less inclined to go ahead and exercise the put into short stock. Many investors don't take that route, so you may need to look for another way to get short deltas and continue the trade from there. But on the flip side of that, if the stock is higher and we think it's going to keep going higher and we're reached expiration, we don't have any more time, and this is certainly possible. If you choose an expiration just after the event and there's a big move and you think it's going to keep going and I want my deltas, then some sort of position management up there might be necessary, and it could include ponying up for the shares. If you're confident in the move and you go ahead and buy the shares and keep the stock, keep capitalizing on the stock move higher, or you can look for another way to gain your positive deltas and long delta exposure. Now, one thing you may have heard through television articles or economists, they may have referenced the options market predicting, or what the option market tells you is the expected move in a stock after a particular event, in this case, this binary event. You may have heard them say the options market is predicting the stock is going to move 8% after earnings or something like that. It's kind of a common thing for you to hear on TV or something like that. And really, there's two different ways that calculation can be made, but here's the simple one, just using the straddle itself. If this is our situation with the stock at 87.5 and we have to pay $4, that means the stock can move within a $4 range in either direction. That breaks even. Well, that's about 4.5% or so in either direction for us to break even on this trade. The buyers and sellers break even at a 4.5% move. And that's, you can interpret, that's what the options market is doing. And that's what those statements mean. In this case, the options market is predicting a 4.5% move in this particular stock after the binary event. And again, stipulating that the binary event is going to be very closely before the expiration date of these options. Very closely related to that is the long strangle. And rather than repeat all of those things, I'll just say them all at once. With the long strangle, we are doing a very similar analysis. We're expecting greater increase in volatility, stock price movements. We are long Vega. Time decay is working against us. The difference here is strike selection. We are not doing at the money strikes. We're breaking those strikes apart and we're using an out of the money call and an out of the money put, in this case, the 90 call and the 85 put. We're going to buy both of those for a 250 debit. And those gain risk numbers are similar to what we saw before. Choosing strikes here is it might take a little more analysis. The straddle is almost always used with the at the money strikes, but the strangle is a bit different. I think it's somewhat open to interpretation, but I think the strangle is used when you have a bit more confidence in a big move coming, because you're willing to, you want a better risk reward ratio, spend less money, go out of the money with your strikes, and try to get a much better return on your capital by going with the cheaper options. So strike selection is a bit more based on risk reward, your risk capital, how much do you want to pony up, and what that expected move is. If you do get a move higher or lower, where do you think it might go? You could interpret a little bit more of directional bias here. If you really think that if it's a move higher, it's going much, much higher. And if it's a move lower, it's going to be a mild sell-off. I don't know which way it's going, so I'm going to buy, say in that case, the 85 put, but I'm going to go up a little higher and buy the 92 half or the 95 call, because if it moves higher, it's going to 100 in a heartbeat. And if you do something like that, you can break the strikes up a little bit more and have a more confident approach in a particular direction. So the price of these options and the expected move play a role when you're selecting strike prices on a strangle, and somewhat my opinion that the strangle is used over the straddle when you have a bit more confidence that the big move is coming. P&L graph looks very similar. Here you have profits gained on either direction. The big difference is in between your strike prices, in between the, in this case, 85 and 90 call. Right here, you have this range where you have break even. I'm sorry, you have a range here where you have losses. Your maximum loss is achieved down at these levels. At expiration, it's a bit different now than we did with the straddle. With the straddle, we assume that we have to do some form of position management, because at some point, one of the options is going to be in the money. With the strangle, not so much. You can't be certain of that. You do have a little bit of a range there, so position management could happen, or it might not be necessary depending on where the stock is. And similar to before, if you're on the downside and you want to continue with short deltas, it's less likely you're going to do that by exercising going short stock. You certainly could, but it's less likely to do that. It's more likely to look for another trade to get short deltas. On the upside, if you do have the capital and you're comfortable with it and you're confident the stock is going to keep moving, it's more likely to exercise the call and get stock in your account. Or if you don't want to spend that kind of cash, look for other ways to get long delta. I just did a calculation on expected move that you might hear, the 4.5% move. There's another calculation that is also widely accepted, and it comes from the concept that options are slightly overpriced, that the at the money straddle not just predicts what the option market thinks may happen with the stock, but actually increases that value slightly. From a conceptual perspective, I would say this is akin to an insurance company who sells insurance. They give themselves a little bit of a buffer. They increase their prices a little bit because of the risk that they're taking on. And there is a widely accepted perspective that options do the same thing, that sellers increase their prices a little bit because of the risk that they take to sell options. In light of that, this other calculation uses both the straddle and the strangle and combines them together. So that calculation is also rather simple. The at the money straddle price plus the nearest out of the money strangle price, add all of those together and then divide by 2. And if you do that, you're getting a slightly smaller expected move in the stock, and you're mitigating the fact that options may be slightly overpriced naturally. And that's another way you can do that calculation to get the expected percentage move in the stock that the options market is predicting before a binary event. This next slide is really helpful to compare the strategies together. We're going to overlay the strangle on top of the straddle here in a second, focusing first on the center, or here the at the money strike where our greatest loss is, and the break even points on either side. When we put the strangle up here, we'll we'll look at where those differences are between those three pieces. And here is the strangle. We saw this, we talked about it, but here it is up against each other. You see where the straddle sits with a greater cost. Well, that's undoubtedly going to be the case. We're paying more for 2 at-the-money options than we would be paying for 2 out-of-the-money options. A greater cost, greater chance to lose money, more risk capital. However, those break-even points are at lower levels. So it becomes a little bit more tricky to decide between these two. I gave you some thoughts earlier about risk capital and the strangle possibly being perceived as a more confident opinion that the move is coming. Even though you can make more money here, you can have a greater return on your capital with the strangle due to lower cost. And if you have a particular bias one way or the other, you can break this strangle up from its traditional construction and maybe move out to the higher strike prices. If you think about each side individually, just buying a long call option, the higher you go in strike price, the less it's going to cost and the more confident you are in a big move. If you get that big move, your return on capital is going to be much, much greater for the further out of the money options. So similar to that analysis, I would say that is why I'm identifying the strangle as the slightly more confident or aggressive trade between the two. But the rest of the characteristics are very similar, and as you can see here, the P&L graphs are also very similar. Time decay is certainly a huge factor, and you do need stock to make a big move. And this statement is the conceptual description of what I had said earlier of the difference or the forces of delta and theta. You are going to have both of them. As your stock price moves, the delta of your position is changing. And as each day passes or as volatility changes, you have those effects on your position as well. The straddle or the strangle probably start with just about no delta at all. Considering, well, straddle certainly if you're buying at the money strikes, strangles if you're buying the same delta options out of the money, you would expect them to start with no delta. But as the stock moves, one of those options is picking up deltas and one of them is losing them. And those deltas start to work in your favor as the stock continues to move. The effect of theta, we know what that's going to be. That's going to be negative. And the effect of implied volatility, we don't really know. We have an idea and a prediction on it, but we don't really know what that effect is going to be. So you have all of these different dynamic effects on your position, the delta, the Vega, and the theta, and they could be, well, we know where theta is going, but the delta and the Vega could be working in conjunction to enhance gains or against each other to enhance losses. Key takeaway here is these strategies are usually implemented before an event of some kind, and it could be anything. I have a list of some things here, but anything at all. It could be macro, it could be microeconomic in perspective. It really could be anything. Choosing your expiration date is going to start with the event itself and how long you think that event may have an effect on the stock price itself. Generally, you're choosing an expiration date right after the binary event, but you could choose to give yourself a little bit further time if you think, and you may know this because you're familiar with the stock itself, after those events, the trend continues, it keeps moving in that direction, and you want to give yourself more time. So the expiration date certainly has some flexibility there as well. And here's back with our contact information, the website optionseducation.org, the great guys at the investor services team that'll be glad to help you out with any and all questions. Send them an email, options@theocc.com. We have a ton of new videos on our YouTube channel. All of our 2019 webinars are now up there. We do 2 webinars every single month. I'll be presenting one next week on July 17th. We just had one yesterday. We're going to be focused on buying options for the 3rd quarter of this year. So we do 2 webinars every month. Please visit the website, sign up for those. That's probably our most popular product right now. And then our social media outlets, Facebook and Twitter, are up there as well. And that takes me down towards the end. I'm not sure who's on the line, David or Teresa, but if there are any questions, I will be glad to answer a few for you.
Hi, Ed. I'm here. This is David. And how's it going?
Good.
Great class.
Thank you very much. Yeah, I enjoyed it.
So DMAC, I'm here as well. If you want to take the questions in the box here, I'll be keeping an eye out over here on Discord if anybody has any questions over there.
Yeah, it looks like the only question that I've picked out, there are several, but most of them were in the beginning about the start time and if it's a recording, which it is a recorded webinar, so you guys will be able to watch this at a later time. So did we get into condors? Will you do condors too in this this webinar? So I don't think that was addressed.
No, I mean, we do, and it's a great suggestion for future reference, excuse me, but not today.
Okay. Is anything on Discord, Teresa?
No, there's not. Just a thank you for a great class.
Well, great. And like I said, if anyone's got questions, feel free to shoot them out to that investor services team and they'll help you out.
Sounds good.
Wonderful,
Okay,
wonderful.
guys.
Ed, thank you again, as always. That was spectacular.
Always a pleasure, guys. Thank you very much.
We'll see you next time, Ed. Thank you.
Guys, bye-bye.
Bye.